In this recording, we're going to look at Summer 16 Question 1. Again, focus particularly on IAS 1 and your technique around how you approach a trial balance and financial statement question. So again, I'm assuming you've read through this question, even tried to make an attempt at it. I'll just briefly go through in terms of how you've set up the question, because we've gone through this in previous examples as well. First thing is you look at the requirements. We now know we've 3 statements to do. Usually it's a minimum of 2, statement of profit and loss and statement of financial position. And a lot of the time statement of change in equity can be thrown in as well. So you have that in the back of your mind when you're going through it. You have a quick look at the trial balance, and I'll highlight some of the things I would have spotted as you go through. And then you have a look at the notes to see what standards came up and is there any links to other notes or links to the trial balance. So here you're given opening inventory because the year end is 2015, that's the start of 2015. We have dividends, which is related to note 2. Depreciation at the end of the year. Be careful there, that's not accumulated depreciation last year, that's actually accumulated depreciation this year. Because you'll see down here, they've already charged depreciation for the year. So we have a note related to that, so we'll have to come back to it. Sometimes if that said 2014, you'll have to charge depreciation for the year. So we'll come down, loan payable in 2016. You're told that because that means it's a current liability, because we're doing the year in 2015. You have tax payable, you have bank, wage and salaries, light and heat, they're all expenses. Admin expenses, distribution costs, no issue there. Dividend payable now. So we have a dividend up here, which is on the debit side, and we have a dividend payable of 500 here. So we have to figure out what's going on there in note 2. And then you have opening retained earnings, which is a closing from last year, and you have an opening reval surplus. So you're probably going to have a working in terms of a property or equipment revaluation as well. But just get that discipline, highlighting the key things as you go along, and when you go through the notes then figuring out, well, which line items link to which notes. It only takes a while, but it's good to get it set up. So as we go down along, I'm just going to briefly look at each one first to flag what you should be looking at. So closing inventory, that's IS2. And then you have an adjustment for lower of cost to net realizable value that we'll get to. But all I'll be writing there is IS2 adjustment. What you're told here, dividend in the trial balance relate to 500 dividend paid and 500 dividend proposed. So that is why the million is up here, the two of them added together. And that is why only 500 is on the credit side here, because the 500 that was paid in July would have been credit bank. So that's going to be IAS 10. That deals with dividends and how you account for them. Trade receivables, you're dealing with bad debts and you're dealing with provision for bad debts. So again, I wouldn't get into the nitty gritty of what's going on yet, other than to say, I know it's a normal bad debt provision, and you'll come back to it. And you might draw a link from trade receivables, the note, up to trade receivables, the amount, which is 2230. Just setting yourself up that you know what's ahead of you, and you can figure out then what order you want to take them in as well. Interest expense has to be accrued, that's fine. And wages and salaries and light and heat need to be split out. If they're manufacturing costs, if you want to flag to it, that will go to cost of sales. If they're admin costs, of course, they'll go to admin expenses. The new law is passed during the year. We have to install fire extinguishers, and there's about 75,000 of work to do with that. And they're also announced or informed close to the year end that there's going to be a 15,000 fine. And what they've done is they've accrued for the installation, but no accrual has been made for the fine. So that's around IAS 37. What should you create a provision for? And we'll come back to that in due course when we go through the rest of them. So you flag there IAS 37. You're told then in note 7 that the depreciation expense has been calculated in error. So we know from the trial balance they have a depreciation expense in. They have them here as we highlighted. But you're told here equipment was incorrectly calculated, straight line instead of reducing balance. And the revaluation of property needs to be, a revaluation needs to be done at the year end. And they tell you how to go about that. So note 7 and note 8 are very much linked together. It's all around IAS 16. Note 8 gives you the policies. Note 7 gives you the errors. So we'll come back and we'll look at IAS 16 in total, looking at note 7 and note 8 combined. Note 9 then is corporation tax. You're told that the amount of the trial balance represents the amount of tax owed at the end of last year. That's an important date. So that amount that's up here in the trial balance, tax payable, 1.1 million. That's actually how much you owed at the end of last year. And why that's there is they haven't actually accounted for the bill for this year, which is 1 million, and the preliminary tax paid for this year, which is 900,000. So you're going to have to make your entries to see how do you update for that as well. And finally, then in general admin costs, an insurance expense of 600,000 was paid halfway through this year for 12 months. So that's a simple prepayment that you have to deal with. So you will get more advanced issues around IS2, IS16, etc. But you will get the basics, bad debts, bad debt provisions, prepayments and accruals as well. So it's important that you know your basics coming from AF1. So your next step then is really personal preference. Some students like to set up a template, 1 page for the P&L, 2 pages for the statement of financial position, and a page for the statement of change in equity. Others prefer to leave it till the end. My recommendation always is leave the pages at the start of your answer. So when the first thing the examiner sees in the answer is the finished financial statements, and then you don't mind how long your workings are thereafter because you have space left for it. So whether you want to set up a template or you want to leave it till the end, I would leave the pages at least so you can go back over it again at the end. So what we're looking at here then is we're going to go through each of the notes. You may, in an exam, you may want to think, actually, I'm going to go a different sequence now because I want to tackle the easier ones first, or I don't like the look of note 1, so I'm going to leave that till the end. So again, that's personal preference. You just make sure you have some strategy in place to look at that. So we're going to start then in note 1, which we said is IAS2. Closing inventory was 6 million, but of that there's 150,000 which was sold after the year end at a discount of 100 and it's sold for 95. So actually we're dealing with after the year end here. There's 2 standards at play. You have IAS2, but you also have IAS10. So what we're saying, the cost of the inventory overall is 6 million. The cost is 6 million, so we drop the last 3 zeros to make it neat. And what you're saying then is within that, there's a cost of 150, whose net realizable value at the start of next year is 95. Now, that's an important point because in IAS 10, even though it's sold after the year end, it gives us evidence of a condition, i.e. a write-down of the inventory that was in existence at the year end. So what IAS 10 says is that is information that you should update your inventory. So you're going to reduce your inventory, your new closing inventory. What you're going to say is going to be 6 million minus the difference. So the difference here is you're writing it down by 55. So if you want to say here, the difference there is a write down of 55. So even though it happened after the year end, that is covered in IAS 10. So that's an important one that you understand. So that is your 6 million, just so you'll know where it's coming from, minus 55. So the debit and credit there, or if you know where it goes, you can just put in the adjustments. Unless you're explicitly asked for the debits and credits, you don't need to give them. Debit inventory, current asset, credit cost of sales, 5945, 5945. That's your first working done, but you have to get the discipline there of putting in the standard, and there could be multiple standards in the same requirement. So just make sure you're alert to what the information is given. So that's your first working done. So all you do is come back, label the next one, and move on. Nice and neat. Dividend to trial balance, interim dividend paid, and a dividend proposed at the year end. Now, this is covered again by IAS 10. Interim dividend paid is okay. Proposed dividend not allowed until approved by shareholders. So in this case, 500 of that dividend should be reversed. Credit dividends and debit dividend payable. That's clearly covered in IAS 10. What they've done for the dividend paid would be debit dividends credit bank, and that's fine because it's paid out, it must have been approved. But the one that's proposed at the year end, but it hasn't been approved, you're not told there, that's not allowed under IAS 10. It's only allowed to be adjusted for once it's approved by shareholders at the AGM, which usually happens the next year. So it's a simple IAS 10 adjustment, but again, if you didn't know your standards, you would have been stuck on that quite quickly. And that moves you to working 3 then, which we know is our bad debts and our bad debt provision. So you're told Trade receivables, 500,000 at the year end, went into receivership after the year end, 5 days later, and you said you're going to get paid 20 cent for the euro owed, so you're going to write off 80%. 200 other bad debts have to be provided for, and they want to adjust their trade receivables to 2% in line with past bad debts. So the first thing is IAS 10 is relevant again here. Similar to what we did in working one, if you have a receivership after the year end, that gives you more information. This company was probably a bad debt at the year end. So you're going to have a bad debt of 500 times 80%, because you're only getting 20% back, which is 400, and a specific bad debt, which you're told as well, of 200. So what you're going to be doing there is writing off bad debts of 600. So just read the question, don't write off 20%. That's how much you're going to get paid. So that 20% stays as a trade receivable at the year end, because you'll get it at some time in the future. The other 80%, the 400,000, is written off. And that is debit. And do they tell us where it goes here? So we'll put it to debit admin expenses. And you're going to credit trade receivables. And that will be 600, 600. So that's your bad debt. It always credit trade receivables. And they want the provision to be 2% of your trade receivable balance. So if we go back and look here, we're just checking, is there any opening trade receivable provision? Because if there is, we have to recognize a movement, but there doesn't appear to be. So you're going to create a new provision, and it's going to be 2%. Be careful now. The trade receivable in the trial balance is 2230 minus 600. You always take off the bad debt before you get the provision. And that will be 32.6. So that will be debit admin expenses. You don't credit trade receivables. It's actually a separate line item, although they are netted off in presentation purposes. Credit bad debt provision. So 32.6, 32.6. But again, you're getting the marks as you go along, but a lot of that is AF1 level. So the basics of bad debt provisions will be examined again, likes of accruals and prepayments as well. So as you finish it, slot it off. So I said some people, they'll prefer to slot all them in as they go now. That's perfect technique. I'll just leave it at the end so I'm not moving up and down the screen all the way through the recording. Working 4, then we're told in the question, is interest expense for the loan is yet to be accrued. So what that means is your loan is 5% of 100,000. So you're going to debit finance costs and you're going to credit interest accrual, and it's just going to be 5, which is 5% of 100. So you're told that in the question, so you just follow through on that. So your finance costs are 5,000. So if you were dodgy enough about a couple of the workings, you could have done the easy workings first. Do inventory, do this accrual, do the prepayments, and get some marks on the board. There's nothing wrong with that as long as you cover them all at some stage and you clearly label your workings as well. Working 5 then is wages and salaries in light and heat. You have to split it out. So 70-30 for manufacturing. So you're going to debit cost of sales, debit admin expenses, and you're going to credit wages and salaries. So you don't need to do this for debit and credit, but just to show you what the split is. Wages and salaries, we're told here, is 5-4. So get rid of the wages and salaries. You're going to put, what are we told? 70% into cost of sales, and you're going to put 30% into admin expenses. So that's all you need to do. Again, you don't have to show debit and credit, but it's just easy to show where it's coming from and where it's going. Then light and heat is the same, but the split is 80-20. Let's change that to L and H. Your light and heat amount, we're told in the question, if we go up, is 6725. 80% goes to cost of sales, 20% admin expenses. And if you had expenses table opened up, which a lot of students will, you could be slotting them in as you go. But we'll leave that till the end to make it easier. So that's just merely a presentation issue than anything. That's kind of covered under IAS 8 because you have whatever you did last year, you have to maintain consistency this year to allow comparability of your financial statements year on year. Working 6 then, we're told a new law is passed on the 1st of June that they have to install fire extinguishers. And at the end of the year, they haven't installed them. And the directors estimate 75,000 to carry out the work. And they've been fined 15,000 because they've delayed installing them. Installation costs have been accrued under advertising costs and included in trade payables. But no accrual has been made for the fine. Now this is under IAS 37 and it's a particular example. No provision for install costs until a contract is agreed. Now this is a tricky one because you're thinking, well, surely the present obligation is coming from the new law. Now technically this is the actual example from IAS 37. It's quite tricky. The logic in IAS 37 is you only have a present obligation when you sign up to a contract to install the extinguishers. So you sign up to some supplier of these. Until then, you could actually just sell the property and you would have no obligation. Now that is tricky. You might think, oh, that's very nuanced and very tricky detail to look at, but that's a well-known example in IAS 37. That 75,000 does not become a provision, even though you have a law requiring it, until you sign up to some fire extinguisher supplier and have a legal contract to pay them 75 to get the extinguishers. The only thing you will do for now is you have to pay the fine because that is there. So what you're going to do is credit advertising costs 75, debit trade payables 75, and you're going to debit here admin expenses for the fine 15, and you're going to credit trade payables 15. Right, so you can put it trade payables, you can put it other payables, that's fine, but the key point is we'll keep it a separate line item. We'll say provision for fine. So the key point that's quite tricky is you're not allowed to recognize that until you have actually a present obligation. And the change in law isn't the present obligation because you could in the intervening period sell the property and you don't have to install them. So it is quite nuanced. Don't worry too much about it. It doesn't come up that often, but it is a well-known example in IAS 37. All right. So we're then on to working 7, which we're going to do work note 7 and note 8 together, which is to do with IAS 16, property, plant and equipment, incorrect depreciation, and also fair value adjustment as well. So we're told here equipment for the year was incorrectly calculated 20% straight line instead of 20% net book value. So we have to adjust for that firstly. So you're told here, there's your equipment, and they charged 2.8. So you're told down in note 8, your equipment is 20% reducing balance. So what they've done is they've got the 14 million. They put it here. They've got 14 million and they've taken 20% of it. So they've done straight line, which is incorrect. It should have been, now you have to be careful here, that 6.5 is accumulated depreciation at the end of the year. So we want to know what was net book value at the 1st of the 1st, 15. The cost was 14 million. The accumulated depreciation, this is quite tricky to have your wits about you, is the 6.5 minus the 2.8 that was incorrectly accounted for, which would have been, don't add them, you will take one from the other, 10.3. So your depreciation there should have been 20% of that figure, which is 2,060. That should have been the depreciation expense. So what you're essentially saying there is you've over depreciated. The equipment depreciation shouldn't have been like that. So you're going to have to make an adjustment. So what we're going to say here is we're going to credit equipment depreciation 2.8 because that was wrong. That's the one in the trial balance. So take that out. You're going to debit cost of sales 2,060. So why I'm putting equipment depreciation and cost of sales, you're told down here all equipment depreciation is related entirely to production. That means it's a manufacturing cost, therefore it should go into cost of sales. So you need to read your notes carefully to see what it's telling you. And the difference then, which is a debit accumulated depreciation, because it shouldn't have been added 080, you'll add back 740. So accumulated depreciation should be 740 lower because it was overcharged during the year. So it's going to go from 65 down by 740. Right, that's an important one. That 740 comes from 2800 minus 2060, which is your 740. So that's your first entry to adjust the equipment. The property, then you're told, owner-occupied properties are accounted for using the revaluation model. They're depreciated over a useful life of 50 years, and then re-estimated when the reval is finished. Does not elect to transfer depreciation. That's a possibility or an option under IA16. And it's allocated evenly between the three: cost of sales, admin, and distribution expenses. So we're not told it's been accounted for incorrectly. So we're assuming the figure is fine, the depreciation of the property of 60. But what we need to do now is do a revaluation, because you're told down here the property is revalued in note 7. You're told here journal has yet been recorded. It was last revalued last year and our valuation increase. That's where our reval surplus is coming from, 200. And you're told then depreciation has been charged correctly. However, the revaluation now is 25 and the remaining useful life, it remains unchanged. So what we're saying here then is net book value at the 31st of 12/15, and we'll put up here just to make it easier to follow the solution again. That's the equipment. And then we'll put down here, that's your property. So what we're saying here, the net book value at the end of the year, just be careful now you're including, is 3 million minus 60, 2940. The revalued amount is 2500. So that's a reval loss of 440. Now what a lot of students would have said, oh, that reval loss goes straight to the P&L. This is a second time revaluation. You firstly remove all reval surplus and excess loss goes to SOPL. So that's important, you know the rules in IA16. They are the IA16 reval rules. If the first time it's easy, this is the second time. So what are the debits and credits here? You debit accumulated depreciation, 60. You say you have to clear that out because there should be no accumulated depreciation at the end of the year. You credit the cost account, 500,000. That goes from the 3 million down to the 2.5. You debit the reval surplus, and the reval surplus in the trial balance is 200. You remove all of that because that's now wiped out. And what you do then is you debit the SOPL, the difference, which is 240. So the amount of the reval loss over and above the reval surplus goes to the P&L, and we will put that through admin expenses. So that's quite tricky in IA16, but you need to have your wits about you about a second time reval downwards. How are the rules applied? Right, so we've all our entries there, and we finished that at the end of the year. So just keep an eye on that as you know how to approach it. So what we're also told in, just to make sure we complete that one, is you're told depreciation for property, right here. Depreciation for property is allocated evenly across the three. So technically here, we'll probably allocate that 240 as well across admin expenses, cost of sales, and distribution costs. Just to be safe, it's going to be 80 times 3. So when we're doing it out, we may as well be consistent. Likewise, depreciation for property, which is 60, is going to be allocated 20 across the 3. Just when we're doing it out, because we're told in the question where depreciation is allocated, you most likely will match that with your allocation of your any reval loss as well that goes to the P&L. So it's just more presentation issues than anything, but don't lose out on easy marks. So that was working 7. We're now looking at working 8, and this is to do with taxation. Just tidy up that to make sure they're all the same. So taxation, you're told the opening balance there of the 1.1 million is balance owed for last year. No adjustment has been reflected the amounts paid related to 2015. They settle the tax bill outstanding, so the first entry will be debit tax payable, credit bank, 1.1 million. That clears out the amount that was owed for last year. So you see, you have to be careful in reading the question what it's telling you. Tax will not be the same adjustment every time. Sometimes it won't be an adjustment at all. So you have to read it carefully. During the year then, they paid preliminary tax of 900,000 and did a tax expense of 1 million. Well, the tax expense is debit the SOPL tax, 1 million, and you're going to credit tax payable, 1 million. And of that you paid tax, debit tax payable, credit bank, 900. So you actually have paid in advance 90% of that bill. So the closing tax liability at the end of the year will only be 100,000 because you've paid preliminary tax for the rest of it. But they're the key journals that you're looking at as you go down along. So your last working 9 then is the one we've looked at with admin expenses. We're told in admin expenses here in the note that there is insurance prepaid for 6 months. You paid on the 1st of July halfway during the year, but it covers 12 months. So you have an insurance prepayment, quite a basic one. Debit prepayment is a current asset, half of the annual bill, which is 300, and you will credit admin expenses to say it shouldn't be in there, that's an expense for next year. Now that shouldn't cause students any trouble, but get the basic ones, get the accruals, get the prepayments, get the simple bad debt provision, and get time then and build some time for the harder ones. So the last working we always do is our expenses table. This is where we look and try and do a working for cost of sales, admin expenses and distribution costs here, rather than trying to do it on the face of the financial statements, because you could have a load of adjustments as we will have here, and it'll make it quite messy otherwise. So we start off with cost of sales, which is obviously the starting point here will be your opening stock, your purchases, and your closing stock, which we know is coming from working 1. So your opening stock and purchases will be coming from the trial balance, given directly here, 4 million and purchases 32 million. So 4 million, 32 million. And we said closing stock, if you come from working 1, you cross-reference down, that is 5945. And it's the minus because it is a credit to cost of sales, which reduces cost of sales. Now we have a couple of other things. This is where it's important to tick them off as you cover them. What other elements do we have in cost of sales? Well, we'll come down working 2, working 3. So working 5, you have 3780, which is wages and salaries, and light and heat 5380. So slot those in. Wages and salaries, you have here 3780, and then 1620 goes to admin expenses. Light and heat, you have 5380, and then the difference 1345 goes to admin expenses. So it's nice to have that columnar structure. You capture both as you go down along. So we're then told anything else for cost of sales, 2060 for equipment depreciation, and 80 and 20 for the property. So we'll do those. So equipment depreciation, 2060. Reval loss is going to split across the 3, 80, 80 and 80. And property depreciation is going to be split across the 3, 20, 20 and 20. So you're just slotting, capturing as many things as you can as you go down along. So I think that's all the line items we have for cost of sales. Just skip down a few and we'll tot those up. So your cost of sales then will be 41,375. Admin expenses we have in the trial balance. So we just add on the key item there. Your admin expenses are 2125 and your distribution costs 1230. 2125 and your distribution costs 1230. So we just took those from the trial balance, show the examiner where we took them. Just double check is there any other expenses that should go in. The only other expense in your trial balance that we haven't included yet will be advertising costs. And that's usually in distribution, 1700. And we have some adjustments for that, which we'll get to in a second. So there's quite a lot of workings here for this exam question. So we'll go back then and see, is there any adjustments to admin expenses? And we have here a 600 in working 3 and a 32.6 in working 3. So we'll slot those two in. Bad debts, 600. Bad debt provision, 32.6. And we'll just say there, working 4, working 4. So round to 33 is fine. So that's working 3. And then we have the working 5 complete. Here, working 6, you credit advertising cost 75, so that's credit your distribution, and debit admin expenses 15. So that is working 3, working 3. Just put up here, that is working 5, working 5. So here we have the provision adjustment, which is minus 75, and that is coming from working 6, and then working 6 to fine, which is 15 into admin expenses. Just put there working 6 as well. So you're just trying to capture everything as you go along. We'll go to working 7 and see is there anything. Working 7 we have in already. We have the depreciation in, we have the losses. Working 8 is nothing to do with admin or distribution costs, and working 9 is the prepayment. So prepayment, working 9, minus 300. You're saying that's a prepayment for next year, and that depreciation is working 7. We've had less, working 7, working 7. So hopefully we nearly have all of them now that we can tot them up and see what the line items are. But you have to get that discipline of going down through each of the workings, tick them off where it goes, which the line items, and having a look at the trial balance and doing the same thing. So your cost of sales of that, your admin expenses, 5538, and your distribution costs, 2955. But there'll be a lot of workings going for that. And because there's so many adjustments there, it doesn't make sense to try and put them in the face of the P&L because it's going to look very messy. So we'll take those figures now, we'll bring them back up, and we'll start our profit and loss. So we have here working 8, working 8, and working 8. We've no profit and disposal this one. It's from an older question. And we just slot them in. Tidy up this. So our cost of sales, we said, was 41375. Our distribution costs, 2955. And our admin expenses, I think it's rounded, but it's 5537.5 or 5538. It's fine. So that's a lot of them complete already. With very little work, but it looks nice and neat, and you'll get your presentation marks as well. The revenue in this case, no adjustment, so it's just trial balance, and our revenue at the top is 51 million. So that means your gross profit is 9625. We've no other income, so we leave it out. So your operating profit will be 1132. Finance costs, we had 1. There's nothing in the trial balance, but we did do working 4, 5. Debit finance costs 5. So working 4 minus 5. And that will be 1127. And your tax bill for the year, again, we did an adjustment on this. If you come back to working 8, we debited the tax P&L. None of the other adjustments impact the P&L, just this one. Tax bill of $1 million. That is working 7. Just double check that's working 7, is it? Sorry, working 10, that is working 8. So these are working 10. And that's working 8. And that is minus $1 million. So your profit is 127. And of course, hopefully you don't forget, we had other comprehensive income. Revaluation loss, Because remember, if you make a reval loss, it goes through the OCI as well. We debit a reval reserve in working 7, this reval surplus, but that also goes to OCI. You have to show the movement. It's a loss of 200. So reval loss working 7 minus 200. So what we call that is your total comprehensive income for the year will be a loss of 73. But you have to get that presentation as well, because that's a key aspect of how IA16 reval works. Right, so just double check that you're happy enough with that, where it comes from. You don't put in the 440 there. 240 that is put into expenses. The other 200 goes to OCI, because that recognizes the movement on the reval reserve. So what we're going to do then is we're going to go on and we're going to look at the non-current assets, the statement of financial position. We have equipment, which is working 7, and we have property working 7. Just double check in your trial balance you have any other non-current assets. Always tick them off to go along, and it doesn't look like we have here. So for our equipment, the net book value will be the 14 million minus, be careful now, we said the 6.5, put in brackets, 6.5, that was overstated by 740. So the true equipment figure, the accumulated depreciation should be lower. So your net book value there will be 8240. Property, the net book value will be 2.5, which is the revalued amount, because it's revalued at the end of the year, and you've done your revaluation adjustments for that. So that's the only ones you have. Sometimes you might have intangible assets or things like that. We don't have it in this question. Current assets, the normal ones, inventory, trade receivables, bank, and we also know now we have a prepayment. That's from working 9. That prepayment is 300. That's your insurance prepaid. Our inventory is coming from working 1. That is 5945. It's just nice, important to cross-reference to show the examiner where it's coming from. Trade receivables, that is coming from working 3. If we want to go back down and have a look at it. Your trade receivables, you had bad debts and you had the provision for bad debts. So your closing trade receivables here is going to be the figure on the trial balance, which we said was 2230 minus 600 minus 32.6. Which is 1597, or if you want to round that to 1598, that's fine as well. And your bank then, just be careful with 1 or 2 adjustments to the bank. That is the opening balance 55. In working 7, we paid tax of 1.1 million and we paid 900. So that's our tax working. I think that's actually working, just double check. Trial balance minus working 8. Yep. So your closing is 5500 minus 1100 minus 900. So 3.5 left. And that means your current assets here will be 11342 and your total assets 22082. So that's why this approach is probably not the best one where you leave it till the end. I'm only doing it to make it easier to show it all on the same screen. If you had a template set up and you're slotting them in as you go along, you'll probably get a lot more marks and you run a lot less risk of leaving out something obvious. In the equity, we've ordinary share capital and retained earnings. And just for completeness, we will show the reval reserve as well, reval surplus, because it's important to remember if the reval surplus is nil, it still has to be shown in the statement of change in equity. So it's important to probably leave it in here so the examiner or you'll remember to put that in as a column in your statement of change in equity. Ordinary share capital hasn't changed. It still is 500. Retained earnings, be careful now. It's the opening retained earnings of 20670 plus the profit for the year, not the total comprehensive income, the profit of 127. and minus the dividends of 500. You do not recognize the dividends of 1 million because 500 of those we said were incorrect. So your closing retained earnings there are 20670 plus 127 minus 500, which are 20297, and your reval surplus is nil because we've said at the end of the year we've gotten rid of that. So your reval surplus has been taken care of because it's been removed based on the loss. In the question here, you would have been incorrect to put the loan in as non-current liabilities because it's repayable in 2016. That means it's a current liability. So you're going to have your loan, which is 100,000. You're going to have your interest accrual, which we said is working 5 or working 4, is it? Go by the P&L, working 4. And that is 5. So you owe money at the end of the year. Your trade payables, but you're also going to have one or two others. So we'll just leave a bit of space. You're going to have trade payables. In the trial balance, trade payables is 1140. So trial balance, but you also have to adjust for the incorrect provision. So we said down here, trade payables working 6 must be reduced by 75. So minus working 6. Trade payables are 1140 minus 75, which is 1065. Your tax at the end of the year, just be careful about the tax one. We'll reference there working 8. Your tax was you owed at the start of the year 1.1 million. You paid that off. You owed 1 million for this year and you paid 900 off. So of all those adjustments, you're left with a net tax liability for the year of 100. And the final one then is the fine, which is working 6. The provision for the fine is 15. So there is a good lot of stuff there, and it's quite tricky. So it's important that you have your wits about you to make sure you capture everything that's required. So that gets you your current liabilities to be 1285, and add that to your equity, gets your total equity and liabilities to be 22082. And again, thankfully it balances. You know you're on the right track. Just tidy that up to the right format. So that's your second step, is do your P&L, do your balance sheet, and the last thing you're going to do now is take these 3 line items. Again, if you left out reval surplus, you're going to miss a column in the statement of change in equity and you would have been wrong. So you have to show the reconciliation. Even if it's nil at the end of the year, you have to show how it got from being something to being nil. The reval surplus and here. So your closing balances at the end of the year. Here you're going to put in 500. Your closing balance for retained earnings, we'll just take it from below, 20297. And your closing balance for reval surplus, which is getting you a mark, is nil. Even if it's nil, you have to show how it got to nil over the year. There's only really 3 or 4 things you're looking for here. The first thing is the obvious one, TCI for the year. It's not profit for the year because if you have other comprehensive income, you put the 127 here and you put the minus 200 here. So that's how it should be presented. So your total comprehensive income for the year is a net loss of 73. If it was just profit, it'd just go to retained earnings column, but because you have an OCI as well, you call it total comprehensive income and you put it on the same line. The other ones you could have is a share issue. We don't have that here, but we do have dividends. And dividends are a minus 500 to retained earnings. Right, so all of this we've done before. There's no new accounting in the statement of change in equity. It's just presentation. We don't have any IAS 8 change in accounting policy or prior period error, so we don't need to restate the opening balances. So that means these are the plug figures. Opening must have been 500 because the closing is 500. The opening in the reval surplus must have been 200 because 200 minus 200 gets me nil. So there are marks going for this, so don't throw the marks away. And the last one then working back, the opening retained earnings must have been the closing minus what you added on, add back what you took away, is 20670. And when you look in your trial balance, there's your 20670. So you know you're on the right track. But I said there is a couple of marks going for that. Do not throw it away. The four main ones that go to the statement of change in equity are the result from the profit and loss account, TCI for the year here, dividends, share issues, and IS8, change in accounting policy or prior period error. Right, so that was a full exam question from Summer 16 question 1, focused on reading the question, laying out the answer, and finishing it off. Right, so it's important you put practice on those because it's a guaranteed question. And all you have to do then is you don't know which adjustments are coming up. But as you'll see from going through past papers, there's a lot of overlap in those adjustments as well.